The Federal Home Loan Banks are 11 U.S. government-sponsored banks that provide reliable liquidity to member financial institutions to support housing finance and community investment. With the members, the FHL banks represents the largest collective source of home mortgage and community credit in the United States. Overview. The FHL bank system was chartered by Congress in 1932 and has a primary mission of providing member financial institutions with financial products and services that assist and enhance the financing of housing and community lending. The 11 FHL banks are each structured as cooperatives owned and governed by the member financial institutions, which today includes savings and loan associations, commercial banks, credit unions and insurance companies. Each FHL bank is required to register at least one class of equity with the SEC, although the debt is not registered. A primary benefit of FHL bank membership is access to reliable liquidity through secured loans, known as advances, which are funded by the FHL banks in the capital markets from the issuance of discount notes or term debt, collectively known as consolidated obligations. COs are joint and several obligations of all the FHL banks, i.e. any debt issued on behalf of one FHL bank is the responsibility of all for repayment, with the issuing FHL bank having the primary responsibility. The Office of Finance serves as the fiscal agent for the FHL banks, with responsibility for offering, issuing and servicing COs, as well as preparing the combined financial reports. Although the individual FHL banks are SEC registrants, the FHL bank system is not. Thus, the FHL bank system financial reports are properly viewed as combined, rather than consolidated, ownership. The 11 banks of the FHL bank system are owned by over 7,300 regulated financial institutions from all 50 states, U.S. possessions, and territories. Equity in the FHL banks is held by these owner members and is not publicly traded. Institutions must purchase stock in order to become a member. In return, members obtain access to low-cost funding, and also receive dividends based on the stock ownership. The FHL banks are self-capitalizing in that as members seek to increase the borrowing, they must first purchase additional stock to support the activity. FHL banks are exempt from all corporate, federal, state, and local taxation, except for local real estate tax. The capital investments in FHL banks receive preferential risk weighting exemption treatment from the Basel II rules. The FHL banks pay an assessment of 10% of annual earnings for affordable housing programs. The mission of the FHL banks reflects a public purpose, but all 11 are privately capitalized and, apart from the tax privileges, do not receive taxpayer assistance. Financial results and condition. On March 27, 2015, the FHL Bank's Office of Finance published the 2014 Combined Financial Report. For 2014, the FHL banks recorded net income of $2,245 million. Combined assets of the FHL banks were $913.3 billion as of December 31, 2014. Of this total, advances equaled $571 billion. Investments were the second largest component at $267 billion. Mortgage loans held for portfolio were $44 billion. The FHL banks made affordable housing contributions of $269 million in 2014. The principal assets of the FHL banks are advances, mortgage loans held for portfolio, and other investments. The FHL banks are required by regulation to hold collateral in excess of the actual loan amount for any given borrower. The FHL banks are funded through the daily sale of debt securities in the global capital markets. All 11 FHL banks are jointly and severally liable for the liabilities of each individual FHL bank. Since August 2006, all 11 banks have been registered with the United States Securities and Exchange Commission, and all financial statements and other filings are available to the public at the SEC website. At December 31, 2014, each of the FHL banks was in compliance with its statutory minimum capital requirements, and the FHL bank system as a whole is above its minimum capital requirements. On August 5, 2011, the Federal Housing Finance Agency announced that the FHL banks had satisfied their obligation to make payments related to the Resolution Funding Corporation bonds. The banks were required to pay 20% of the net income toward the REF Corp bond payments. Each bank now pays 20% of its net income into its own separate restricted retained earnings account until the account equals 1% of that bank's outstanding consolidated obligations. History. As a result of the Great Depression, the FHL banks were established by the Federal Home Loan Bank Board pursuant to the Federal Home Loan Bank Act of 1932. This was in order to provide funds to building and loan institutions, providing liquidity and making mortgages available. As a result of the savings and loan crisis of the 1980s, the Financial Institutions Reform, Recovery and Enforcement Act of 1989 abolished the FHLBB and transferred oversight responsibility of the FHL banks to the Federal Housing Finance Board and regulatory responsibility to the Office of Thrift Supervision in the Department of the Treasury. FIREA also allowed all federally insured depository institutions to join the FHL bank system, including commercial banks and credit unions. As a result of the late 2000s financial crisis, the Housing and Economic Recovery Act of 2008 replaced the FHFB with the Federal Housing Finance Agency. The Secretary of the Treasury was authorized to purchase FHL bank debt securities in any amount through December 31, 2009, after which the limit would return to the original $4 billion. On September 7, 2008, the U.S. Treasury announced a new credit facility for the 3 housing government-sponsored enterprises. This enabled the Secretary of the Treasury to purchase FHL bank debt in any amount subject to the pledging of advances and other assets as collateral. The authority for this facility expired on December 31, 2009. As a result of the late 2000s recession, Section 312 of the Dodd-Frank Wall Street Reform and Consumer Protection Act mandated merger of OTS with the Office of the Comptroller of the Currency, the Federal Deposit Insurance Corporation, the Federal Reserve Board of Governors, and the Consumer Financial Protection Bureau as of July 21, 2011. On July 31, 2014, it was announced that the Federal Home Loan Banks of Seattle and Des Moines were discussing a potential merger. The merger was completed on June 1, 2015. Related legislation to amend the Federal Home Loan Bank Act to authorize privately insured credit unions to become members of a Federal Home Loan Bank, a bill that would amend the Federal Home Loan Bank Act to treat certain privately insured credit unions as insured depository institutions for purposes of determining eligibility for membership in a Federal Home Loan Bank. This change would make such credit unions eligible for membership in the Federal Home Loan Bank system.